Okay, everyone, it's 8:31, so I will call the meeting to order of the other post-employment benefits trust fund investment committee this morning. Welcome, everybody. To those of you who are in the classroom or in school, good luck on your final few weeks. I know it's a busy, kind of crazy time as next week begins graduation week here at FCPS. So at this time of year, this is our last meeting for fiscal year 26. And so we won't be meeting again until August. And with that, we do have some committee changes that will be happening. So I just wanted to give a quick update on the committee member updates. So thank you to Megan Quinn, Derek Hoover-Beat, and Renee Milburn, who will be remaining on the committee for another term. Stephen Austin, who I don't think is here yet this morning, he will be leaving the committee at the end of the fiscal year, and a new community member, Michael Sinaway, will be joining the committee when we meet in August. We will have a new retiree representative. Thank you, Shirley, for your service to the committee. And as soon as we have that name, we'll hopefully have someone in place when we meet again in August. And we will be having a change to our recording secretary for the meetings. Lynn, who all of you know, has been serving as my executive assistant and the executive assistant for the fiscal services leadership during her entire tenure at FCPS, is actually staying with FCPS, but there's been a little bit of a shuffle to her job. So she'll be moving to our safety and emergency management team, because the majority of her job is spent dealing with our property and liability insurance. So as we've looked at opportunities to improve our efficiencies at FCPS, that's one of the opportunities to do that. And Julie Marker, who you've seen on the screen perhaps, she is the executive assistant for our COO, Dr. Paul Lebo, and she will be helping me moving at the beginning of the fiscal year with my administrative duties as well. So she will now be our recording secretary moving forward. So for those of you who are leaving the committee, thank you so much for your service. We really appreciate it. And for those of you who are remaining on the committee, again, thank you so much for your service. We really appreciate it. And I see that Stephen is now on the meeting, and I don't know if you heard when I announced that Stephen would be leaving the committee, and we were able, the board appointed a new community member at their last board meeting, and at the end of May. My goodness, it's hard to believe it's already almost June. So with that, we'd like to move on to the approval of the February 20th, 2026 meeting minutes. Do I have a motion for the approval of the minutes?
I motion to approve the February 20th, 2026 OPEB meeting minutes.
Thank you, Derek. And is there a second?
A second.
Thank you, Shirley. Okay, and all those in favor, please indicate by raising your hand. Okay. Excellent. It looks like that we have everyone has indicated that they are in favor. All righty. So with that, I'm going to turn it over to Tanya for our update on where we are for the period ending March 31st.
Thank you, Heather. Good morning, everybody. Can you hear me okay? Okay, perfect. Let me share my screen. So okay. Can you see the, excuse me, analysis of investment performance? No?
Nope, we can't see it.
Okay, let me try that again. I don't see the share button anymore. I'm sorry. It's kind of grayed out. Oh, okay, there it is. Maybe it just took a second to refresh. Let me try that again.
It sounds like Tanya may have been kicked out. Tanya, can you hear us? There she is. Tanya, are you back?
I am. It seems like the video might be being streamed on my internet. So,
Do you want me to try to share my screen?
If you could, that would be great. Thank you. And I'm
All
going
right.
to keep my video off just in case that helps.
Bear with me 1 minute. Okay, let me see here. Is that showing up for everybody?
Yes.
Okay, and Tanya, can you see the screen?
I can, yes.
Do you want to start here or on the quarterly?
Let's start on the quarterly.
Okay.
So we'll start with an overview of the market conditions. Obviously, really tough quarter. If we're looking at just the first quarter of the year, returns negative, particularly in the equity markets. There was a really strong start to the year in January and February, and then in March, with the war in Iran, returns became more volatile during the end of the quarter and were negative, as you can see, for the S&P 500, which is the U.S. equity market, down 4% for the quarter. International down 1%, and emerging markets slightly negative. But all of those areas over the longer term time periods, the 1 year, 3 year, 5 year, and 10 year, all positive, mostly double digits. And when you'll see when we look at that update through couple of days ago, markets have really rebounded significantly since then. So a tough kind of point in time analysis when we're looking at the returns through March. But we'll look at more positive trending numbers moving forward. If you could, Kristen, just go ahead. The next couple of slides kind of delve into the underlying areas in U.S. equity and international equity. And then on page 7, you can see fixed income, and you can see on the bottom of the page is the federal funds target rate, is the green bar on the bottom, central bank target rates chart. The Fed did cut rates 3 times at the end of last year and has not made any cuts thus far this year, and we don't at this point see cuts coming really anytime soon. Inflation numbers now are a bit higher than the 2% target and seem to be trending upwards. So we don't expect the Fed to make any additional cuts right now. At the top of the page, you can see the yield curve, and the brown line is where Treasury yields were as of the end of the first quarter. Really across the curve, yields rose during the quarter, which was the green line was where yields were as of the end of December last year. And on the next page, you'll see fixed income returns and the U.S. aggregate index for the quarter just slightly negative, down 5 basis points. Longer term numbers still trending very, very favorably, up 4% for the 1 year and over 3.5% for the 3 year. And other areas of the market, particularly high yield, where we have some exposure through our Core Plus manager, those numbers up 7% for the 1 year and 8.5% for the 3 years. With that, I would jump ahead a couple of pages to the executive summary, and this highlights kind of the points we'll talk about When we look at the report, so you can see the asset value as of the end of the quarter was 226 million, which was down about 5 million from where we were last quarter. The return of 2.3% during the quarter underperformed the policy benchmark, down 1.9. And then the asset allocation really comfortably, again, within the target ranges that we've set here. There was one capital call during the quarter for Hamilton Lane Private Credit, and that was funded from the Fidelity Total Market Index Fund, which is the U.S. equity fund. So this shows your asset allocation. Again, we're working towards funding that private credit target. So that's why you see that underweight there, but still within your policy range, which is why we set that 0% as kind of the bottom. But we've been funding it since Hamilton Lane started making capital calls last year. So slight overweight to U.S. equity and about a 4% overweight to fixed income as of the end of March. And if we looked at those numbers today, they'd be a little bit more overweight to equity and underweight, not underweight, but the overweight to fixed income is much smaller at this point in time, given the moves that we've seen in the market really since the end of the first quarter. So that's why we keep taking the capital calls from U.S. equity, as we've seen really the strongest returns there. So there's, you're getting gains in the equity market. We're pulling those off the table to use to fund the private credit strategy when those capital calls come in. On the next page, you can see kind of growth and cash flow. The fiscal year to date period growth of just about $13 million. We did have that contribution that came in the earlier part of the fiscal year of $1 million, and then growth of 11.8 million gets us to 226 million as of the end of the quarter, and a 5.5% rate of return through the first 9 months of your fiscal year. And on the next page, we'll look at the longer term performance versus benchmarks. So fiscal year to date, up 5.5%, trailing the policy slightly, which is up 5.8% on a 1 year basis, just above the policy, 13.5 versus 13.4, and longer term pretty much in line or just above your policy. And you do have a large portion of your assets in index products. So between the total market index fund and then the Fidelity U.S. Bond Index Fund, more than half of your plan is passively managed. So the manager outperformance expectations overall for the total fund, are lower than they might be if we were invested in all active managers, for example. So on the U.S. equity side, again, total market index, you're getting exposure to the broad U.S. equity market, and that's been up 18% for the last 1 year. American Funds Euro Pacific, or UPAC, is your active international equity manager, up 22% for the 1 year, trailing their benchmark a bit. You can see that, trailing about 2.5% for the last year. The last, I would say really calendar year, so 2025, first part of 2026 have been a challenge for this fund. And that has dragged down kind of the longer term performance that you see here. So kind of a tough endpoint analysis for American funds. They tend to have more of a growth bias, and that has not worked in their favor in the current environment. Some of their selection within areas like healthcare, industrials, and financials have hurt them. So just some of the names they've picked, haven't performed as well as they would expect, and so a bit of underperformance on a relative basis, but still a really strong absolute returning fund, up 22% for the last year. So that's helped your top line overall, being the strongest asset class. So we're watching them closely, but we don't have really concerns in terms of that nothing has changed in their process or team or anything like that. And so we wouldn't put them on the watch list just yet. On the fixed income side, you can see we have the 3 different funds there. So an active core fund with Dodge & Cox, active core plus fund with PGIM or Prudential, and then Fidelity is the passively managed index fund. Both of your active managers over the last year have added significant value over the aggregate index. So Dodge and Cox up 5.3 versus 4.3, and PGIM up 4.9 versus 4.3, and Fidelity right in line at 4.3 as we would expect. So the fixed income portfolio overall has also been additive to your top line. Those are the kind of traditional manager performance numbers. If we go ahead a couple more pages, I think it's 17 in our PDF, you can see there the performance thus far of Hamilton Lane Private Credit. For the quarter, we don't have their quarterly valuation just yet. Those typically take a bit longer because they're not publicly, not based on publicly available information. So once we have that, we would expect your total fund number to increase a bit as well. So not yet a year since we made our first capital call with Hamilton Lane, but since that time, their return has been 6.8%. Their goal for the life of the fund, just as a reminder, is about 10 to 12%, and it's a 5-year term. So we're just about 1 year in, and 4 years left really on the life of the fund. And we, as a reminder, committed $7.5 million to this fund, and thus far they've called about 3.6 million, and so there's about 4.1 million remaining. They had a couple of very small distributions, but those are since it's so early in the fund, they're what they're called recallable, so they may end up calling that money back again. Let me pause there and see if there's questions on March, or we could look at the updated allocation through earlier this week as well. So if you'll recall, the market value when we looked at the March report was $226 billion, and now here you'll see it's almost $247 million. So growth of about 20 million since the end of the first quarter. We've not seen any cash flows, so all of that 20 million is investment earnings. So that would be about an 8.8% rate of return since the end of the first quarter. So if this trend continues, your fiscal year number will be, I guess, upwards of around 15% or so. So looking very favorable for the fiscal year thus far. Markets again have sort of, I don't want to say corrected, but understood, kind of the conflict in Iran, and stock markets have been really on a tear again the last couple of months. With the S&P reaching new highs every day. So assets now, equity is about 51% with that target of 45. So as we get capital calls for Hamilton Lane, we'll continue to take from there. Any questions?
So it sounds like at this point, what we saw in March in regards to the beginning of the conflict with Iran and that decrease, it's corrected, and we don't anticipate that there will be, I mean, I realize that if you had the crystal ball and could make all the anticipations, you would not be sitting here. You'd be on a beach somewhere, right? But we don't anticipate the volatility throughout the summer. And then you had made a comment regarding interest rates, but with the change in leadership at the Fed, is that still the case that we think? I know that's been the Fed's policy for years in regards to the 2%, but with the change in leadership, do we anticipate that will remain their policy?
I believe so. And Christian, correct me if I'm wrong, but I haven't heard to the contrary that 2% is going to change as their sort of bogey.
No. I think there's a realization that we're sort of, 2% in inflation is going to be a challenge for the Fed to get to anytime soon. And, right now, if you look at the most recent inflation readings that came out yesterday, which is the PCE, inflation index, which is typically what the Fed focuses on, particularly the core measure, which strips out food and energy. And as you can imagine, energy is adding quite a bit to inflation right now. But even when you strip that out, the core reading is starting to tick up as well. Not terribly surprising, given the way these things typically work and sort of the knock-on effects of energy prices to everything else, food and otherwise. So, to the point about the Fed, I think important to keep in mind that even with someone in charge now who's been a proponent of cutting rates rather aggressively, while pretty much everybody else, with some exceptions on the Fed, has been more in favor of a more gradual approach and, really looking at the data. The Fed does vote by committee. And so one individual, even as the chair's ability to sort of sway the broader committee is not a foregone conclusion that that's going to happen. And so I think right now, if you look at what the market is sort of pricing in, there's, maybe equal chance between the next move being a hike versus a cut, and maybe a bit more in favor of the next move being a hike. But I think rates could very well stay where they are for a pretty extended period of time. And again, conclusion to the conflict in Iran and what that means for oil prices, and then the knock-on effects to inflation will be a big factor there. In terms of your question about market volatility, the turnaround, 2026 has felt a lot like 2025. There was a sort of shock in the first quarter in 2025. It was tariffs last year. This time it was end of February and attacking Iran. And then the market subsequently recovered. And what drove it last year is in large part the same thing that's driving the recovery this year, which is that corporate earnings are continuing to come in, far above expectations. The first quarter S&P companies grew earnings by about 28% year over year, which is pretty extraordinary. I think the question in terms of, going forward is, if there is a resolution in Iran, will that actually bring down energy prices as quickly as everybody hopes? And then again, you'll still have a ton of uncertainties in the world, and those aren't necessarily going away. So I think the AI spend has been a huge contribution to GDP, and has obviously been the focus of markets more recently. Not just the hyperscalers who are spending something on the order of $700-800 billion this year, but all the sort of more speculative and smaller companies that are kind of latching themselves onto this AI trade. So I wouldn't say that we're confident that there won't be more market volatility, particularly this year. I think the good news for you as a long-term investor is that you have the ability to sort of wait these things out. And what we've learned time and time again is that sort of holding on through this market volatility has rewarded this plan and other long-term institutional investors who have sort of stuck to their policy, rebalanced accordingly. And so again, I think it's just, there's too much uncertainty in the world today to say there won't be more volatility. The hope is that we've kind of seen the worst for this year.
Does anyone in the group have any questions?
Tanya, did you want to comment on Hamilton Lane?
That was going to be my next thing.
Sure.
Perfect.
Yeah, because it is in the minutes that we, our intent was to have them come in and present at this meeting and give an update on, the fund that you're in, Fund 9, and then their next fund in the series, which we presumed would be Fund 10. We learned after our last meeting with you that they're kind of pivoting a bit on their strategy, and they won't be offering a Strategic Opportunities Fund 10. So they're kind of restructuring their offerings. And so, our research group is having, meetings with them, has had, one meeting, and we anticipate more. So until we want to sort of make sure that we gain comfort with what they're going to do going forward before we recommend another commitment to another Hamilton Lane fund. So that's kind of where we are with that.
Hasvani, if you want to go ahead.
Hi, yes. I just had a quick question for Christian and Tanya. I guess as we approach, potentially seeing, we could potentially get like 3% real yield, which we haven't seen, I think probably since early 2000s. I mean, how would you look at it? I know, with the fund being sort of very quite long term, a 3% real yield really is quite attractive long run as far as, being able to have that kind of locked in, right? Would you see sort of a shift there? Because I guess we would see probably a lot of people with a lot of gains, equity gains, probably looking to shift back into bonds, even to just lock in that kind of rate. What do you guys kind of have a thought process of how we would maybe want to take a different view on our strategy, or is it sort of just ride it along and the like? Because it is something that we haven't seen, and normally we then end up with some kind of recession, etc., before there's maybe intervention to kind of again reinflate things. So just wanted to see if you guys have been thinking about that, what you guys kind of your view is as we approach that level.
Tanya, did you want me to start, or did you
Sure.
want to?
No, go ahead. Thank you.
Great point and good question. So real yields, which are inflation adjusted, to your point, look very attractive right now. If you look at yields on bonds in general, in a very short period of time, really since the end of February, we've seen, depending where you look on the yield curve, and particularly in the middle and longer part of the yield curve, which means intermediate and long maturity bonds, you've seen, on average about a 50-60 basis point increase in those yields. And when yields go up, it's typically painful because bond prices come down. The good news is on the other side, you're now investing at more attractive rates. And so, if you look at a 10-year treasury today, yielding about 4.5%, or if you look at the core bond aggregate index, also yielding about 4.5%. And historically, bonds have had significantly less volatility than equities, in addition to being a diversifier most of the time to equity. They're all that to say they're more attractive now than they were just a few months ago. I'd say a few things to point out are, number one, the existing allocation to the bond portfolio today is a bit less than 40%, about 37%. So it's not unsubstantial. What we typically do is we revisit the mix between stocks, bonds, and in this case, for this plan, private credit, when we look at the asset allocation. So the next time we're going to update our assumptions will be early next year. There's no reason that we can't, and I think the plan as of last meeting was after the Hamilton Lane discussion, just to do a refresher based on our this year's capital market assumptions. So we can certainly do that for the next meeting and just revisit that mix. But I think an important point is when we last updated the investment policy statement, it was really in sort of the towards the end of 2022. And that was the period when we saw yields shoot up the most. And so we did, from an asset allocation perspective, sort of try to take advantage of those higher yields. And my expectation is if we do this analysis again for the next meeting, we can look at that mix and show a few different scenarios that do slightly increase the bond allocation as well. Even with a 4.5% yield, and yield has historically been also a pretty good predictor of longer term bond returns, keep in mind that we're sort of shooting for what's currently an actuarial assumed rate of return of just under 7%, 6.75, I believe was the last, maybe 6.7. And so, you still will need to take pretty significant, I'd say, equity risk, and private credit helps with that as well in this portfolio in order to get a long-term return that's approximating something closer to 7%. But we'll take a look, do some different modeling, and I think show you at the next meeting. But it's a great point. And obviously, anytime you can trade in some of the equity risk, particularly when the markets have been as hot as they have, and bring down the overall volatility of the plan, that's something that we want to look to take advantage of. So good question.
Are there any other questions from the team? Okay, so so I guess that leads us to think about what the next meeting will be, right? So I guess at that point, we still will not be ready to really talk about the private credit yet, as you're still doing the research. Is that correct? Okay. And so then we'll talk about looking at is our investment mix. That'll be a topic of conversation that we can have to review the investment mix at the next meeting in August. Okay. So when we met I think it was the last time or the time before, we typically have always had one meeting in person. And unfortunately, the last time we had our meeting in person, it ended up being a terrible snow day. So, I am agreeable to doing virtual meetings. I think because we all seem to come from different locations, coming to this Frederick Central is not always the easiest trek, especially for an hour-long meeting. If we were having a more in-depth meeting, it might make more sense. But I do also like the opportunity to meet in person, because that does, it's much nicer than looking at everybody on a screen. As we are still, I don't know about you, still getting used to these virtual meetings on the regular. So if that's the case, I don't know if the group has a determination, or is it something we want to wait until we have our new members in August to determine if an in-person meeting either in December, February, or May be agreeable. We will absolutely keep the August meeting as virtual. It's right after we get back to school, and asking any of our in-building team members to leave a building for an hour is probably not really the best use of our time in August. So we'll put that on as a conversation to have in our August meeting as we welcome some new board members or some new committee members then. If that's okay with the group. I see some head shaking, so I appreciate that. So if there are no other questions, I believe that we are finished for today. All righty. Well, thank you guys so much. For those of you in our schools, thank you, and good luck for the remaining few weeks. And since we won't see each other again until the end of August, I hope everyone has a wonderful summer and has the opportunity to relax and refresh and enjoy, hopefully, some beautiful summer weather. Thank you guys so much, and have a great rest of your day.
Thank you.